So what can the Fed do? Literally almost nothing. It can't control inflation. It can't control the job market. It says it could. It's its dual mandate, but it really can't. And globally, what's happening is more and more central banks, which colluded to save each other and themselves in the wake of the financial crisis of 2008, are out for themselves. As there's more dollar diversification, as their own economies and supply chains of natural resources and commodities are more and more important, and they want more and more control over that around the world, different alliances are being built to really focus on that, and they supersede what any individual central bank is able to, including the United States. Things happen outside of the Fed's purview and increasingly will.
Kitco News special coverage of the Rule Symposium, Natural Resource Investing, is brought to you by G Mining Ventures.
Hey everyone, I'm Jeremy Szafron. This is Kitco News on location in beautiful Boca Raton, Florida, here at the Rick Rule Symposium. Of course, you're going to recognize our next guest. She is a guest favorite here at Kitco. She knows everything about the macro world. Dr. Nomi Prins joining us. Thanks for making the time here with us today.
Thank you so much. It's always such a pleasure to be with you guys.
You've been busy here. I've been watching you work in the room. Really interesting people around here. Investors have some optimism. What's the room been like since you've been here?
It's been really interesting. This is an annual conference, and what I've been noticing this year in particular is, yes, first of all, there's more attendees. There's more investors looking into the commodities arena, everything from gold to silver to rare earth elements, and there's a true buzz that's really even larger than it was last year. So talking to investors and talking to mining CEOs has been incredibly enlightening this year.
Oh, I like to hear that. Okay, I want to get into a little bit about the conference, and we're going to get into your $3,000 gold price call that you did last. We're close, and I think you're onto something. Citi this morning, the analyst there calling a $3,000 range on that. But first, I want to start with Jerome Powell. He's in Senate, day 2. Obviously, he's keeping rate cut hopes alive. What are your thoughts?
Yeah, he was really battered, I have to say, on a bipartisan basis at the Senate Banking Committee hearing, which preceded the House one. And a lot of them were asking some very specific things of him, which is that, okay, you're seeing that unemployment has risen. It's a 4.1%. It's over 4%. It wasn't there since 2017. It's not awesome. So you can't actually say that labor's doing that well or that it's in the right trend. And he looked uncomfortable. And then there were questions about the housing market. Housing prices continue to rise. With rates this high, mortgage payments are increasingly a harder thing for people to pay. That is going to create more tension in the banking system, more tension for individual homeowners and therefore renters around the country. And these were the things that were basically being pelted at him, and he had to agree that these are the things. So the next question is, all right, well, inflation, what do you think? He's still saying it's not where he wants it to be. He's still sticking to this 2% story. But the reality is he cannot control inflation. The Fed cannot control inflation. And if it's going to be above 2%, a little bit below, at 3, at 4, at any given point in time, they really can't do anything about supply and demand, geopolitical events, or anything else that drives inflation. And I think he knows that, or he's finally recognizing that, and he couldn't really admit it in Congress, but he heard what was being said because he says he's data dependent, and all of the data they were discussing is basically painting the same picture, which is that it is time to cut rates.
Right, and I mean, you're talking about the data. The data's been revised so many times, and we see it coming back worse and worse and worse. What are your thoughts here? I mean, are we looking at the correct data?
That's really interesting, because what we're not looking at actually is how that pattern is really developing externally, because when you're getting revisions, it's all after the fact. But if you look at the revisions are actually increasing. So what that means is, the actual specificity of the data analysis is either wrong or late. And either way, though, it's still showing the same pattern, which is the unemployment rate is going up. The employment scenario isn't great. Wages compared to inflation is still losing. And inflation, even though it's come down a bit, is still connected to higher prices on everything. And these are all indicative of a really much tighter economy. And we have seen on a general basis, and GDP isn't an awesome figure, it misses a lot of things, but last quarter's GDP was only 1.3%. Adjusted for inflation, that is negative growth. So things aren't looking on a full-on general macro basis that good.
Yeah, and to your point, he keeps bringing up this 2% goal, this 2%. That's his reality, but what's the reality for people on the ground? I mean, inflation hasn't went anywhere. People are still feeling this in their pocketbooks.
The reality is people are still getting pinched. The average cost of a mortgage payment has nearly doubled in the last few years as the Fed has increased rates. And what that means is that people are, before they pay for anything else, paying for that mortgage or paying for rents on someone else's mortgage, and all of that's higher. And all of that is beating inflation. The 2% number is completely arbitrary anyway. It was something that was sort of considered, discussed, and vaguely written down in the 90s. It's largely irrelevant to what people's experience is and to what the Fed can actually control anyway.
Yeah, you know, it's interesting. There was a story out with Bloomberg today, and they say U.S. commercial property crash is set to deepen, and there's going to be pain elsewhere. I'm curious about this. Powell yesterday said that the Fed says that commercial real estate is to be at risk for probably years.
Yeah, that was an interesting, push aside the actual growing problem that the regulators, including the Fed, are supposed to be actually addressing, saying, and he said in the past it's contained, which it to an extent is, to regional banks, and therefore it's not going to impact the whole banking system. That is actually not true. It is true that regional banks hold the most commercial real estate loans on their books, but they also have a lot of loan deals that connect back into the larger main banks. And so if commercial real estate gets marked down, if the collateral declines in value, it's going to impact the liquidity that the big banks can provide, which is something that the Fed will have to look at. Right now, and this is a really scary statistic that I was just looking into from some analysis that I was doing, which is that the rate of increase in commercial real estate delinquencies and defaults right now is outpacing what it was before the 2008 financial crisis for the subprime market. So that means even before you mark down, which banks are not doing yet, the actual value of the properties, there are already declines in the payments that are coming into these loans, and they are outpacing the rate that they were before the last crisis. So these are things the Fed shouldn't just be saying, well, it's going to be a problem for a long time. These are things that the Fed should be getting out in front of.
Yeah, interesting. Okay, well, let's come back to the commodity side, because obviously that's what we're discussing, and this is all relevant to the price of gold and silver. What are we seeing here? I mentioned you mentioned 3,000 the last time. We're getting close. I mean, we hit all-time highs. There's still a lot of momentum in the market. Give me your forecast here. What are your thoughts?
Yeah, so I mean, last year when I had this conversation with Kitco from this very location in Boca at the Rick Rule conference, gold was around 1919. It was exactly 1919, and of course now we're around 2,400. Why? Because inflation has been persistent. Because central banks, which we know have been purchasing more gold. China, except for the last couple months, I think it's just on a breather, has had 16 months of straight purchases. India is purchasing more and more gold. Turkey, a lot of the emerging market countries, as they diversify their trade relationships away from U.S. dollar-denominated trade. That's going to continue. That's priced it up. But retail has really been getting into gold more as well. And there's a couple reasons for that. It started actually last March when some of the regional banks in the United States went under. The Fed didn't notice it did. They did. And gold kind of rallied about 10% just in the wake of that last March, last April. Then it kind of stabilized, and it's gone up since then because of these fears that we've just been talking about that are also in the banking system. Gold is not just a hedge for that inflation that's going to persistently stick around or not be controllable. It's also a diversifier for the risk of our banking system. We saw gold appreciate substantially in the wake of the financial crisis of 2008, and a lot of that was because of buying outside of our system. But now, which we did not have then, we have more and more retail buying. The inflows into gold ETFs have increased, and particularly not just in the United States. In China, where, again, China, big buyer on a central bank basis, the ETFs there for Chinese retail customers have had a major increase and an upward trend of inflows. And so what that means is throughout the world, people are getting involved in buying gold as well. So all of that is coming together to, I think, have gotten the price to gold to the 2,400 range it is today. Last year I said it would get to 3,000 by the end of this year. I still feel very comfortable that in the wake of our election, whatever happens, that adds more uncertainty as well into the overall environment, that we will see gold at those 3,000 levels.
Yeah, I'm so curious. Yesterday I caught your panel, and you were kind of arguing that the central banks aren't really in control of this market here. The fundamentals are a little different with the retail really coming in. Talk to me about that and explain to the audience your perception there.
Yeah, I've been a big student of central banks since I worked on Wall Street, since the 90s, since I've traveled around the world. I've met with literally all of them over the years. And there was a power that they really had in the wake of the financial crisis to collectively cut rates, to collectively do QE, to buy bonds, to hold up their liquidity in their own systems and with respect to each other. But now what's been happening in this whole we need to fight inflation scenario is that what we have seen is inflation has come down in pace, but coincidentally, just because of time and the economics of supply and demand, not because the Fed raised rates. And why do we know that? Because as the Fed has paused in the last number of months at that 5.5% level, nothing's really changed in inflation. The only thing that's changed is prices have continued to go up, just again a bit less quickly than they have in the past. The Fed can't control that. So what can the Fed do? Literally almost nothing. It can't control inflation. It can't control the job market. It says it could. It's its dual mandate, but it really can't. And globally, what's happening is more and more central banks, which colluded to save each other and themselves in the wake of the financial crisis of 2008, are out for themselves. As there's more dollar diversification, as their own economies and supply chains of natural resources and commodities are more and more important, and they want more and more control over that around the world, different alliances are being built to really focus on that, and they supersede what any individual central bank is able to, including the United States. Things happen outside of the Fed's purview and increasingly will.
Yeah, it's so fascinating. I mean, you talk about hedging, obviously the retail audience going and buying gold, but their Costco's selling out of gold. We've really seen it take over as a trend. That trend's not going anywhere.
No, it's not. When you see Costco running out of gold bars, you know it's not going anywhere. And there's a lot of different ways to actually be involved in gold. There's buying gold coins. There's buying portions of gold bars on various different platforms, so you don't have to actually worry that it's a $2,400 price. And we've also seen that filter into silver, which is a far cheaper price point. And also silver has other use values in energy transformation and other things. And we've seen retail finding its way into that area as well. I don't see any of that changing. I don't see instability going away. I don't see inflation going away. I do see growth going down in general, and we've talked about that. Right. I don't see central banks not diversifying anymore, not wanting to stockpile non-dollar denominated assets in their reserves. There's no reason that any of that should be stopping.
Let's switch over to silver. I mean, it's fascinating what we're seeing right now. Silver's broken past that $30 resistance, and it seems to be maintaining. And there's a lot of momentum here. Obviously, we have the dual use of it. But I'm curious, those retail players, I guess, if you couldn't find gold, there was a lot of people going and picking up silver. And, what's the value in that?
Yeah, the value is, it is cheaper, and it does tend to follow gold. Although what's happened is that relationship sort of broke down a little bit, that sort of gold started to rally more quickly than silver, but then silver really caught up because the historical relationship is such that it needs to catch up. So right now, even though gold is at all-time highs, silver is only at 60% of its highs in the past, and those highs were basically in a time where we didn't need as much silver for all the energy transformation. So that use value has increased. Silver still has a long way to go to get to even its historical comparative to gold. And I think it will supersede gold because for retail, it's easier to physically wrap your mind around and mentally wrap your mind around a $30, $31, $32 per ounce price tag than $2,400. Even though you can buy gold in slices through these different platforms, you can buy an ounce of silver. You can log into the U.S. Mint site or the Perth Mint site or whatever it might be, and you can actually purchase a certified silver 1 ounce coin, and you can have it, you can keep it, you can give it to your children. So there's all of this, I think, is connected to why silver is going to continue to rally.
Yeah, there's something certainly nice about holding it. Okay, well then, when we talk about silver, yesterday you were in the panel and you were really stressing this energy transition that's happening, and I think it's really positive because the long-term effect for the mining community, it seems it's obviously not going anywhere, but talk to me about these, rare earth metals and things like silver that are going to get us into this next chapter where globally it seems to be going.
Yes, so globally, and not just in the United States, but throughout the world, there's more and more focus on remodernizing power grids, on building them, on building factories to create more chips, to house more data and data analysis. I mean, there's all sorts of needs for the actual physical materials that build these things, build factories, build chips, and there's needs for the power that drives growing populations and transforming into more cleaner energy sources than we've had in the past. Why? Because they're just more efficient. They're more economic. That's one reason, for example, we've seen uranium, which occupies this space as a commodity, but occupies this energy transformation space between oil, natural gas, and coal, and solar, wind, and other types of energy, because it's a very reliable source, nuclear, of energy. So we've seen in the past year that the UK and the US and other countries are promising to triple their use of nuclear energy over the future. That requires building plants, that requires building small nuclear reactors, that requires materials, that requires magnets, that requires all sorts of other application platforms that require minerals and metals. And so all of this is not going to stop either. So regardless of what's happening on a broad economic basis, the US sort of 1.3% slowing relative to inflation, the world slowing down a little bit, these growth mechanisms, this infrastructure, these energy transformations are going to continue, and they're going to change the world. If we look at Brazil, for example, Brazil has a significant pile of rare earth elements. And actually it's funny because when we talk about rare earths, they're actually not that rare. That's the joke inside the rare earth community. They're not rare, they're everywhere. The rarity is actually getting them out of the earth and processing them. That's the problem. And currently, China processes 90% of the rare earths on the planet, and they hold in their land 60%. So from a national security perspective, there is a big incentive to diversify that for the United States and any other country that wants to be independent and grow its technology and its energy. Right. Brazil occupies that place in between where it has a rare earth deposit. And I've actually just, full disclosure, joined the board of a company called Meteoric Resources, right, which is a rare earth elements company with its purview on 250 kilometers worth of rare earth elements that are near the Earth's surface. Mm-hmm. So what does that mean? It means that the pain of digging, the environmental disruption, the energy costs, which in Brazil are very, very cheap because they have actually net positive power capacity, are much less. So when the United States or anyone is looking for diversification, Brazil is going to start to be a player as well. So there's a lot of things that are happening throughout the world on the entire commodity chain that are in change.
You talk about China, and it's so fascinating because they really are manipulating the market. They can control prices. We have to send all the raw material to China. I know Canada, the government there, just stepped in to cancel a deal that was happening with some rare earth metals. Are governments watching?
That is such a good question. I question that every day. They are watching. They're just really very slow to react. Uranium and nuclear was the perfect example. It took Russia invading Ukraine in 2022 for the United States to pass significant legislation, which also took about 2 years to occur, for the United States to try to take control of its own supply chain of uranium for its own nuclear energy power sources. So these things just take so much time. And one of the things about Congress, I spend a lot of time on the Hill, is that there tends to be this follow the leader or be popular on legislation sort of thing. No one wants to stick their neck out. So if they are watching something, or if like 5 Congress people are watching, or 10, they need to wait to 30 or 40 or actually having a conversation about it before legislation even begins to pop out. So everybody feels they're on the right sort of thing. That's starting to happen with critical minerals and rare earths. And again, it took a while to happen with uranium, but we're seeing that. They're watching. They're just slower than they should be to actually.
It almost seems like they're putting the stockpiles. They're just holding stockpiles. There's nothing to do with the raw materials. Where do we send it? We're stuck. We have to go to China.
Exactly, and that's why we're also going to need to develop either production capacity here, more manufacturing capacity for those things. It's one of the reasons why there was an act, the CHIPS Act, which passed in August of 2022, which basically allocated $39 billion. It was a $52 billion allocation, but $32 billion to something called the America Fund to fund new fabs for semiconductors in the States. We used to control 40% of the chip manufacturing in the world. We now control the United States 10%. So this legislation is to basically jumpstart that for much of major companies that are in that environment. So again, it takes a while. And in that process, we're still paying other countries to do things for us, like China, but it's evolving, it's changing. So if you are investing in this space, you have to be a long-term investor, but there is significant upward potential to that.
It almost seems like a new potential in the mining community for that, right? Okay, well, let's talk a little bit about Prinsights Global. I mean, you launched a Substack. It's fascinating. Talk to me a little bit about what people can expect by going there. I mean, again, listening to you talk yesterday, you're talking ROI, there's these advancements technologically that are taking place, and it really seems like you have to put yourself at the end game here.
Yeah, it's interesting because I I travel a lot. You know that. I'm very sort of boots, heels on the ground. I go to the mine sites. I examine the technology. I'm constantly all over the place. And what Prinsights Global is a way for me to take everything I do and have done, you know, the books, the thoughts, the evolving boots on the ground trends, the sites, and put them into one place. So the Substack that I just launched is a way to provide all of that information from me direct to subscribers of what I'm seeing, what we're analyzing. We've just started our first couple of issues. One is on rare earths and the tariff wars on rare earths that will transcend either administration, whether it's Trump or Biden or whoever that's in the White House coming forward. The recent piece I just did was on gold, on this very conversation and what we can expect to see and why all over the world, as well as the analysis of that. So it's connecting that deep analysis with that boots on the ground perspective and conversations with CEOs and investors and minds around.
You're always being taken here. Everyone wants to talk to you, so I won't keep you for too long. But before I do, I need to talk about politics. It's a political election year. We know President Biden, former President Donald Trump sitting there debating. It's getting hot. NATO's meeting right now. Talk to me about, if either candidate gets in, what this looks like in terms of, rare earth metals, the transition, and who's more for it.
That's a really great question. I'll answer that first with the power grid, right? Because if we can't have good modernized grids for our energy needs, a lot of this sort of falls apart. Mm-hmm. And it's interesting because both sides of the aisle, so Republicans and Democrats, want us to have better power grids for this reason. The Republicans want it to have cheaper electricity, whether that is produced, which they want it more so by natural gas and coal. Some of the Democrats want it more to be produced by solar and wind. Either way, it still requires that. They're both starting to recognize that nuclear actually can answer both those questions because it's clean energy, but it's also more reliable than alternatives. So all of those initiatives are actually bipartisan initiatives. There's different thoughts, for example, on why we need to modernize the power grid for national defense and energy purposes. But the result, which is what I focus on, tends to be the same. With respect to the tariffs that I was just talking about, the Biden White House just increased tariffs, for example, on permamagnets, which are in our missiles and defense systems, which require rare earths, from 0% to 25% to start to fight back against what's happening in China and sort of create a path. Very, very new. I would expect that in the next administration, they're either going to raise that, and I would definitely expect a Trump administration to raise that because he has actually said that he would basically create more tariffs with respect to China. So it kind of started under the Trump administration. The Biden administration actually increased all Chinese tariffs, and I think both administrations would increase them further. Why? Because I think there's an underlying bipartisan recognition of our needing to develop and produce and have our own domestic supply chains. There's a lot of other things that are in disagreement, but if I look at energy and if I look at supply chains, I think there's also a lot of agreement, whoever's in the White House.
So policy might be leading not people that are paid to just promote whatever they do.
In these areas, and that's why they're very important to look at. They're there regardless of sort of what's happening at the top, or really the sound bites that are coming out from the media. You don't hear the mainstream media talking about our domestic supply chain or whatever, and both administrations will, and I think underlying they do.
Lastly, to cut through all that narrative, before we let you go, what do you say to investors looking to get into the commodity space right now in this bear market? Where's the entry point? What are your thoughts?
Yeah, so again, I do think with gold and silver that we'll see volatility in everything. We're in markets, they trade. But I think the long-term impact and upside as a secure investment, it's not going to be NVIDIA and increase by 400%, but as a secure investment with use value and international attention, I think you do have to be in gold, you do have to be in silver. I think next from that, if you're looking to get a little bit more adventurous and you need to be in copper, you definitely need to be in uranium and uranium companies, because this is something where domestic supply is only going to continue to be more important strategically for national defense reasons already from a legislation perspective. And there's only a few companies, so mining companies there, that actually produce in the United States and with allies. And then if you're really adventurous, this is a very good time to take a look at rare earth companies outside of China, because as a long-term trend, they are very cheap right now because nobody's paying attention and because China sort of dominates the pricing of the market. So it is quite volatile. But as a sort of tail in your portfolio, it's a very good time for a long-term investment there.
Yeah, look to long-term. All right, Dr. Nomi Prins joining us now. Thank you so much for taking the time. We appreciate it, as always.
Thank you so much.
I'm Jeremy Szafron for all of us here at Kitco News. We want to thank you for watching. We got great content coming up all week from the Rick Rule Symposium. Thank you for watching. Stay tuned.
Kitco News special coverage of the Rule Symposium, Natural Resource Investing, is brought to you by G Mining Ventures.